Is LMI bad and should it be avoided at all costs? Today, we look at that question for both owner-occupied properties and investment. For knowing whether LMI is to be avoided, we've got to set the scene. And with property, it's all about compounding because compounding has an effect over time, not the short term. And with properties, we can see that over the last 30 years that the increase has been 382%. And more importantly, it's been rising on average 5.4% since July 1992. Looking at the actual effect compounding has over a prolonged period of time, we can see that if we take the 5.4% that was previously mentioned and we put it on a $750,000 property, over 10 years, that property will actually exceed $1.25 million. And more importantly, if we look at changing that term from say 10 years to 2 years, we can see that the power of compounding really couldn't take effect. And more importantly, is exactly the reason why you shouldn't pay mortgage insurance. Because the first reason you should pay mortgage insurance is whether or not you'll be able to free up capital. And let me explain that. Okay, say for example, you have a $100,000 deposit and you're looking to buy a property for $500,000. Now, you really have two options. And for the sake of this example, let's ignore all the associated fees and just focus on the deposit. Because you have $100,000, you have options. You can either put a 20% deposit down or you can put a lesser deposit and pay mortgage insurance. The question really becomes whether or not you should pay mortgage insurance. Firstly, knowing that property is all about the long-term gain. It's using compounding to its full effect. We've got to understand that if all you have is $100,000, whether it's wise to have a cash buffer. So what you might do instead is you say, hey, look, I'm going to put a 10% deposit down and it'll allow me to put both $50,000 in my savings account and $50,000 in the deal. This allows you to prepare for any worst case scenario. So if for whatever reason you weren't able to work for a prolonged period of time, it would mean you wouldn't have to sell your home to continue making payments to the mortgage. Because ultimately it's about holding the property for a long period of time. And with property, that's the most important thing you can do. And this really puts compounding in perspective. This is the start of chapter 4 in a book called The Psychology of Money. And it says that $81.5 billion of Warren Buffett's $84.5 billion net worth came after his 65th birthday, and it really shows the power of compounding interest. It's hard to really understand and comprehend these figures, but the longer the investment's left untouched, the more and more compounding has an effect. On the other side, if you're an investor planning to sell the property after a renovation, also known as flipping, then mortgage insurance might come at a cost and may not necessarily be the right thing to do. So if that's the case for you, then this strategy may not be the right one for you. And if you're a homeowner, it's really important to understand the bang for buck, because at certain levels and certain thresholds, you'll actually get more discount on your mortgage insurance than the additional deposit is required. Some common bands include the 90%, so being over 90% or under 90% can have a huge payoff. And we have a calculator that can help you with just this. I'll put a link in the description. But essentially, you can see here that all you need to do is put your loan amount. So we'll go for that 90% loan to value ratio again. So we'll go 449,000. So just under the 90% mark. We'll go for a $500,000 deposit and we'll go ahead and calculate. So what we can see here is that mortgage insurance is roughly $9,500. Now, if we go over that by, let's call it $2,000, let's go ahead and recalculate that. And you can see here that by putting an additional $2,000 down, that you're actually saving more than that on your mortgage insurance. And it's just one example. So it's really important to look at how much money you've got, how much you're hoping to have left over, and seeing where the bang for buck is. And finally, for those that won't have enough money post the deposit and all associated fees, then my advice to you is whether or not mortgage insurance is good or bad is really dependent on the property you purchase, because ultimately getting in the market earlier, providing the returns are there, will make more sense than waiting. But like with all investments, timing the market is near impossible, and many great investors have said just this, because No one knows what the future has installed, and realistically, looking at property, it's all about time in market, not timing the market. And providing your intention is to hold property for a long term, then whether there's $10,000 or $20,000 worth of mortgage insurance payable upfront will essentially be inconsequential, because based on the 5.4% average annual compounding, you can see the effect of paying $20,000, even $30,000 worth of mortgage insurance ultimately becomes null and void, providing you hold the property for a long term. And finally, in summary, whether or not mortgage insurance is good or bad is really dependent on your direction. I'd encourage you to start with the end in mind. What does the next 10, 20, 30 years look like? More importantly, if paying mortgage insurance allows you to have some money left over so that if bad times do happen, it'll get you through them and allow you to keep the property instead of selling it, then I think mortgage insurance is well worth it. And on the flip side, if you have a minimal deposit, thinking about whether to get in the market now or to save up that 20%, then again, think about your direction. And if property is something you're looking to keep for the next 30, 40 years, then again, it's time in market, not timing the market. And on the other side, if you're looking to flip the property, only keeping it for 1, 2, or even 3 years, then mortgage insurance may not make sense, as mortgage insurance just becomes another cost that you have to put into your calculations to make sure flipping the property makes sense. And if you're looking for a great mortgage broker, here at Hunter Galloway, we can help. We service across Australia and don't charge a fee for our service. So reach out and hit us up at huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and until next time, I'll catch you then.